Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with Scott Phillips. Scott, go ahead and tell the people a little bit about yourself.
Morning, Troy. Thanks for having me on. I'm a retired investor, age 67, been retired for a few years. Early on in my career, I was what's called a specialist on the trading floor of the Chicago Stock Exchange. That's a person responsible for making markets in a few dozen different stocks, and did that for probably a good 30 years until the stock exchange became obsolete. Trading in stocks became more and more electronic, and everything. The trading floor was no longer needed, so that shut down in 2005. After that, I went into corporate finance for about 15 years until I retired. Last stop was at Discover Financial Services, the Discover credit card, and then retired in 2020 during the COVID. Couldn't handle the Zoom meetings anymore, so decided to pack it in, and been trading stocks from home ever since.
Yeah, I'm glad you answered my question that I was going to ask about that is like, how did like technology change that role that you had on the, so when you see like CNBC and then you see them like on the floor and they ring the bell just to open the market and stuff, is that all like for fun or like, are they still important or what are they doing there?
The New York Stock Exchange is still important. We were what's called a regional stock exchange that basically traded the same stocks as on the New York floor. We were just another market, and we would attempt to give, I guess, price improvement, just another place to shop, I guess.
So if the technology and like internet and now trading on apps and smartphones and stuff like that, if that was able to like knock your exchange out, like what made what did the New York Stock Exchange do that's different to like keep them important?
They're what's called the primary market, and their specialists actually determine the opening price of stocks. Right when the bell rings, they match all the buyers and sellers, and they'll step in and fill any voids if there's an excess of buyers or an excess of sellers. As far as why we became obsolete and they didn't, I don't have a great answer for that. Just things became more and more electronic. What really hurt us the most was back before 2000, stocks were traded in fractions. You would have IBM at $151.25 instead of $151.25 or whatever, and the spread back then was an eighth, a quarter, a half a point, where now it's a penny or less. And for a specialist, our margin was the price we buy at and sell at, the bid and ask price. And when those shrunk down to a penny or less, it pretty much made our life, I guess, just hard to be or maintain profitability.
Yeah.
Because the spread went down so much.
Yeah, I mean, well, obviously that wasn't I mean, it ended up being okay for you. You ended up retiring and finding a different path, but like it would be,
Right.
I guess that would be better for like the everyday investor, right? Because then you're getting things
Exactly.
closer to the actual price.
Right.
Yeah.
Um, yeah, it's great for people to invest, on their computer.
Yeah. That's pretty cool. Yeah, I was just wondering about that because I was like, as soon as you said that, I was like, are they just like all scrambling around, acting like they're doing something and they're busy for no reason? They're not even
Right.
needed. But yeah, that's interesting. So first question for you is going to be like, when did you begin investing? Like, do you remember how old you are, what year that was, and then like, what did you start with dividend stocks, or did you start with something else and then pivot your way towards dividend stocks after a while?
Right. I became interested in stock market back in sixth grade. I was very early. Um, I was always my strong suit was math, and opened up the newspaper back in those days, and the business section was all stock prices. So I was fascinated by all those numbers and how they changed day after day, and so I had a great interest in stock market back in grade school. And at that time, my mom was in an investors club. Those were popular back in the 1960s for housewives. They would, nowadays it's book clubs and those sort of things. Back then it was investing club. And they would all do their own research of stocks. And then once a month, all the ladies would get together and discuss what stocks they liked. So my mom would take me to the library, and there were the Value Line reports, the Standard and Poor reports, all kinds of reference materials on stocks and corporations. So I was looking through those when I was about 12 years old, and uh, researched my own. And first stock I ever purchased was TWA, Trans World Airline. Uh, that's no longer in existence. But I bought 5 shares for $25 and watched it go up and down. And it actually went up to about $40 when I sold. So my first stock trade was profitable.
There you go. That's not a common story right there either.
Right. At that time, I don't believe TWA was paying a dividend. So um, dividend stocks came later in life. I guess in high school and beyond that, I started buying mutual funds. Um, had money from lawn mowing and catting and birthdays and so forth. I would invest them in a handful of funds, and then after college, I ended up on the Chicago Stock Exchange floor, and then I was buying and selling stocks all day, every day.
Yeah. Did it like not necessarily ruin it, but like did it take the excitement out of doing it like your own portfolio because you do it all day?
Right. It was a whole different kind of um, investing. My own portfolio would obviously be for the long term, where on the trading floor, a long term trade might be an hour long.
Yeah. Were those like trading and stuff? That was harder back in the day with like before the internet and stuff, right?
Right. We were linked to the other exchanges through a machine called a Quotron, where I could see what New York was doing, and Pacific Coast, and Boston, and Philadelphia. Um, but you're right, the internet hadn't really come into its own by then.
Wow.
Um, this
So
was 1980 or so.
we need first of all we need to bring back investing clubs. I mean, I guess that's kind of what groups on Facebook are like now, but like it'd be pretty cool to like have a small group of people in your community that are you all meet and talk about stocks. That'd be pretty fun.
Right.
Instead of
It's
a book club. Nobody cares about your, nonfiction, your little book that you read, sharing your thoughts. Like,
yes.
tell me about some stocks. Let's like make some money. But did you, when you first started doing your own research, like when you would go to the library with your mom, did you ever like see the stocks that she would research and then find your own stocks that you liked? And would you guys ever like talk about them back and forth? Like, well, mom, I really don't like that one. I like this one. Here's why. Like, did you ever do that?
Right. There'd be some of that. I pretty much gravitated toward companies that I liked. I mentioned TWA was my first investment. I was fascinated with flying and the Wright brothers and all that kind of thing growing up. And so airline stocks seemed to fit my interests. And my mom would be interested in, I don't know, healthcare or back in those days, there was what was called the Nifty 50. Stocks like Polaroid and Bosch and Lomb and just a whole slew of companies that a lot of them aren't even around anymore.
Is that more similar to like the Magnificent Seven we have now, or like the S&P 500?
Exactly, like the Magnificent Seven.
Oh, okay. So like the just the biggest companies, the most trendy stuff right now.
Right,
Okay.
the most exciting ones to watch and invest in.
So Polaroid back in the day was like our Tesla today or something.
Exactly. Right.
There you go. Yeah, that works. I mean, to be fair, Polaroid still exists, so there we go.
You're right.
I mean, is Polaroid owned by somebody, or is it still its own thing?
To be honest, I don't know.
Because I know they still have like the Polaroid cameras and stuff like that. And I think their logo is like some kind of like little rainbow square or something like that, and it says Polaroid with it. But I don't know if they're. It seems like everybody that you think of today is like owned by somebody big. Like even
Right.
like soft drinks and stuff. Like you're just like, oh, here's a Dasani. Oh, that's owned by Dasani's owned by Pepsi or Coca-Cola. Like it's not even its own thing. It's under somebody else. So that's pretty cool. So did the mutual funds that you bought, they have like, they're not technically dividends, right? Like those are just what do they call them? Disbursements.
Right. There would be capital gains at the end of each year, and I believe they did pay dividends on a quarterly basis. Nothing real great, maybe 1 or 2%.
Mm-hmm. So it was like, because that's how I've told my story a bunch of times where I signed up for Robinhood. The free stock I got from Robinhood was SiriusXM, and they just paid me a dividend one day. It was a 1 penny dividend, and I was like, "What's a dividend? And why? Like, do I owe this to somebody? Like, do I need to give this back? Like, what did I do?" So it's So like, would you say that mutual fund thing, when you would get your dividends, like that's what started like getting your mind churning of like, wait a minute, I'm making money for just holding this thing. Like, what else can I buy that give me the same thing?
Right. Back then, you could choose whether to take your disbursements in cash or reinvest them, kind of like a drip. And I believe back then I always selected reinvest, and so my position would grow that way. I started at 100 shares, and all of a sudden I'd have 105 shares or so forth.
They didn't do fractional trading though back then. So like, what if you got $20 from company A, but company A cost $40? Like, would they just hold? Like, would that just go to your cash position until you had enough to buy a whole share, or how'd that work?
Oh, I see. Yeah, mutual funds, they did do what's called fractional shares.
Oh, wow. Okay.
Yeah, but if I had bought individual stocks like the TWA, if they had given me a dividend, I don't think dripping was that big of a thing back then.
Yeah.
So for the most part, they would just send you a check.
Okay. Yeah, I was wondering because I know dripping's like not relatively new, but like it's more widely popular now than it, like. I was just talking to somebody. I think they commented on my most recent video, and they said that it was Jim from one of the Dividend Stockyard. He mentioned that his brokerage doesn't offer drip, and I'm like, it's 2024. Like, I feel like if your brokerage doesn't offer drip, you might want to look somewhere else. But
right,
because it should, like, imagine. I always give this example because it's wild, but like imagine your brokerage not offering drip, but you want to own a share of Berkshire Hathaway. Like, you're just going to wait your whole life to own one share. Like, that doesn't sound fun. Like,
right.
Yeah. Cause those things are what, a couple, like $100 and something $1,000 a share or something like that.
Right. The Berkshire A is way up there.
Yeah. Like, if you don't have fractional shares, like, what are you supposed to do about that? Like,
right.
Yeah, you gotta sell everything else in your portfolio just to get one share of that. So,
Mhm.
Okay, so in your investing time, I mean, I know I've made a bunch of mistakes, and I haven't been investing that long. So you've had to made some mistakes, even though your first trade was profitable. You've had to made some mistakes along the way. So like, what would you say is your biggest mistake? It can be stock specific or just idea or philosophy specific or whatever. And more importantly than the mistake you made is what lesson did you learn from making that mistake?
Okay. Um, I guess if I could go back and change a couple things, I got a little too heavy into the REITs. The dividends were too enticing, and so things like NLY and EFC, I'm in a little heavy, and all I've seen is their stock price go down, even though the dividends have been great. Um, so I guess I would have diversified more and not gone so heavy in the REITs.
Yeah, I
Uh,
mean, that's a question I have in the interview, so we might get on into that a little bit later too. But like, there's so many different opinions. Well, there's different opinions a lot. Like they vary a lot in investing in general. But like then you get into like even the smaller details of investing, like diversification. Some people really believe in it. Some people don't believe in it at all. It's just it's pretty wild to hear. And like the thing that makes it interesting is every argument that I hear about that, whether you're for or against, they're all compelling. Because some people are just like, oh, like why would you need to diversify if you have strong conviction on XYZ stock, even if it's in the same sector or whatever? And I'm like, okay, that makes sense. Then other people are like, the thing you hear all the time, you don't want to put all your eggs in one basket. And what happens if that sector goes to crap or whatever? And I'm like, okay, well, that also makes sense. So it's pretty cool to hear like the varying opinions on like whether diversification matters and how much it matters and stuff like that.
right. Nowadays, I'm probably more diversified than 90% of investors. I currently have over 150 different holdings.
You
Uh,
are an ETF.
yes,
That's pretty impressive.
right.
Yeah. Wow.
So a lot of those are actually ETFs and closed-end funds. I currently own maybe 25 individual stocks. Um, but yeah, I try to invest across every industry and every type of asset.
So do you have any actually I'll save that question. Okay,
Yeah.
so that actually is a really good segue between like so the next question is like how would you say your investing styles changed like not necessarily from when you first began to now, but like over let's just say over the last 20 years. Like how has your investing style changed since then?
Well, since I've been retired, I'm more hands-on with the portfolio. Uh, I log on the market for about an hour almost every day, just around the opening or the close, whatnot. Um, so I do a lot more trades, I guess, in I guess individual funds. I'll add on dips when the price goes down, say 5%, and I'll lighten up if it rallies 5%, skim some profits off there. Where 20 years ago, it was more buy and hold for me.
Okay. So the like if you're talking to somebody that's like my age or maybe even a little bit younger, a little bit older, like you still do believe in that method of buy and hold quality companies for long periods of time, and then when you get to your point, you can actually start having fun with your portfolio, kind of thing.
Exactly.
Okay.
Right. You're at the age where you're building up your portfolio. Me being retired, some of the dividends, I use that to live off of. Um, so I'm no longer really growing my portfolio, except for, I guess, you know, if a fund, has price appreciation, then that's great. That's really how I grow things.
So
Uh,
did you like let's just say 10, 20 years ago, did you really focus on dividends when you were that far away from retiring, or were you were dividends a byproduct of like, hey, I'm buying like you obviously filter for companies that do pay dividends, or in this case ETFs or whatever. I don't know of any ETFs that don't pay a dividend, but you filter for those, and then you're like, more importantly, was it like capital appreciation, or were you always on like the dividend side, and then if the capital appreciation happens, it happens?
A little of both, actually. Like a couple stocks I've held for quite a number of years have been Apple and Google, and Apple pays a small dividend, Google does not. So I'd like to include both of those in my portfolio. And then I did have a handful of ETFs that have paid dividends, and I would collect those dividends, and then when it got to a certain amount, then I'd find a new investment to add to my portfolio using the dividend income.
Yeah. Okay. Yeah, because and a lot of people just like, when you are a growth investor, like not a dividend growth investor, just a regular growth investor, obviously you're all hyper focused on stock price appreciation, which, that's because that's your only that's your only option is stock price appreciation. And then you have like dividend investors where they are only focused on their yields and how high their yields are and how much income they can get their portfolio to produce. Then you have like what we try to do is like the dividend growth investing, which is both like your stock's going to appreciate, your dividends are going to appreciate, as far as like what you're going to make year over year is going to keep going up. And if you do it right, the raises from your dividends, so whether you add money or not, that's going to continue to go up regardless. Like that's one of my metrics is just like, I like a 3, 5, and 10-year dividend growth rate above 10%. So whether I put money in it or not, I'm going to get a 10% raise, which is way more than you're going to get from a day job most times. So, and I don't work for these companies, which is really nice. So it's important, in my opinion, for people to realize, like, to me, age doesn't matter as much as like your timeline, like time horizon, whatever you want to call it. Cause like I just turned 29 in October. So like I plan to retire early at 50. So I have 21 years left. But somebody that's 29, but they plan to retire at 67, they might have a little bit different of a plan for their investing style because they have another 30, 35 years to let their portfolio do what it has to do. So that's more important to me. Like that's the reason I can't use like my demographics on my YouTube channel. Cause it's like, oh, okay, you get watched by 35 to 39 year olds. I'm like, great. That tells me nothing. Like in investing, that's pointless. Cause like, I don't know if they're 35 to 39. They just started. They've been investing since they were 16. Like I have no idea. Like that doesn't give me anything. So.
Right. Yeah, for me, I didn't try to pigeonhole myself as a value investor or growth investor or dividend investor. I probably always had a little bit of everything.
Mm-hmm.
And so dividends were, I did enjoy my dividend investments and saw, a handful of those out to include in my portfolio. But I wasn't one type of investor or another.
Yeah, that's good. I mean, that goes back to what you were talking about before about like the diversification. So it doesn't have to be one kind. Like for example, in my Roth, it's all ETFs except for Tesla. Like I own some Tesla in my Roth because it's a Roth, so it's tax deferred. And if Tesla blows up out of nowhere, for good or bad, if it goes up, I'm not going to pay taxes on it. And if it goes down, it's like 10%. So I'm like, okay, whatever. Like I still have all my ETFs to take care of the rest. So, but then like every other stock I own is all dividend focused. But when I say dividend focused, I'm the dividend growth kind of investor where like I just want my company to appreciate in addition to my dividends. And that way, when it comes time 21 years from now, hopefully, it's one of those situations where it's like, okay, is this stock making me enough money to accomplish my goals? And if not, I can take the capital gains, the money I put in, the dividends, all that, take that, sell it, and then put it into something that does help me meet my goals. And I can do that. So, that's at least the plan. We'll see what happens. It's hard to plan for when I'm 50 years old because I haven't been 50 yet. So
yeah, no, that's a great strategy you have there.
Yeah, I appreciate it. Everybody says it sounds like it's going to work, so I hope everybody else is older and wiser and smarter than me. So I'm just like, okay, well, I mean, you guys say I'm on to something, so I'm on to something.
Yeah.
So, okay, so next question. So, do you have any like? I know you said that you're living off of at least part of your dividends, and then like you still find some stuff to like dabble in here and there in your portfolio. But like, do you still have any like short-term goals that you hope to accomplish with your dividend portfolio, and then maybe some like long-term goals that you hope to accomplish, like maybe even like diversification, like maybe away from individual stocks into more ETFs or closed-end funds or something like that? Do you have any of those kind of goals?
Um, Recently, I've been dabbling in some of these alternative type ETFs, the ones from YieldMax or Defiance or Simplify. Um, and they're a very tiny portion of my portfolio, but they're fun to invest in and watch, and they have unique strategies that
Mm-hmm.
I find fascinating. So in the short term, excess dividend income that I don't need to live on, I've been reinvesting in some of those. And a lot of them are option based ETFs that generate income, monthly income, selling options. And options are something that I've been interested in since they came into being around 1975.
That's it. So what are your thoughts on, because I see a lot of people in, the millions of dividend groups I feel like I'm part of, like,
Mm-hmm.
what are your thoughts on some of these people that are in their 20s and they're, YOLOing a lot of their money into these yield max funds? Like, what do you think about that?
That's dangerous.
Yeah.
Like I said, for me, it's a very tiny portion of my portfolio, but uh, like a fun portion that I like watching. But these people that are in their 20s going all in on the yield max funds, that's very dangerous, and I would not recommend that.
Well, yeah, I think I agree with you that it is dangerous. And then the other thing I think is like the thing that people fall into, and this is like something that I've learned in the, I don't know, I've been dividend investing almost 4 years now, but like one of the things I've learned is just like the idea of what we want to do is we want to grow our patty, right? Our passive annual dividend
Right.
income. You want to grow that. So people always, and this is how the yield traps happen, where people are like, what can I do with this amount of money that I have to invest to get that number to go up the highest? Which is also helps people lose focus of the total growth, like the price appreciation in addition to the dividends, and not to mention the dividend growth rate. People don't even consider that. They're just like, oh, this dividend's here. Like you fall into that with what's the MPW? What was the other one? Zim during COVID when the whole shipping container thing. That one was paying a 55% dividend. Everybody loved that one.
Right.
And then Walgreens, AT&T, like all these companies that have these really high dividends, they fall into those. Not only are you losing money, be it like you're losing your original capital. And I always give the analogy of like the company's going to give you $75 in your in dividends in your left hand, and then take $100 from your price on your right hand. And people are like, "Oh, look at the $75 I made." I'm like, "Yeah, but look at the $100 you lost." So, with the yield max stuff, like people are so focused on increasing their patty, but they're not really focused on like not you, but like the people that are that we're talking about. They still have so many more years to be building their portfolio. When you're at the point in your investing journey, when you're actually the income is what you're focused on now. Like you've already done the whole, hey, I'm focused on buying and holding quality companies for long periods of time. You've already put that time in. So now you get to play with these funds. And some of these people are coming in and doing that right off the rip. And I'm like, and I try to tell them in however many ways I can do that. This isn't like, not to say it is or isn't smart ever, but for you right now, not a good idea.
Right. Exactly. The yield max funds, they've only been around for maybe a year at most, and they haven't stood the test of time.
Mm-hmm.
We haven't, what happens if we go through a big bear market? They're going to get clobbered. Um, but you're right. The younger investors should be focusing on having quality investments for the vast majority of their portfolio. Um, you know, maybe 5 or 10% of their portfolio can be these high flying, high paying yield max funds and other things. But if if I was in my 20s or 30s, I would be focusing on quality.
Yeah, yeah. I think it. Like I said, it's just the idea that people have where they're like, oh, my only objective is to grow this passive number, and they're doing it by any means necessary, which they end up achieving their goal, at least temporarily. And I'm just like, okay, like you gotta focus on other things too. There's more things about your portfolio than just like the number that you're bringing in today. Cause I always like the thing I always say on the channel is just like right now, my yield on my portfolio is really low. It's like around 2%, but I don't need my portfolio to generate income for a very long time. I need it to grow and then I need it to generate income. Like there's two separate steps to that. So.
Right. No, 2% is fine. And then, 10, 20, 30 years from now, when they grow their dividend, your yield on original cost is going to be substantial.
Yeah. Yeah. And that's what I mean. So like, there's not even a guarantee that 21 years from now, cause I own Apple, I own Microsoft, I own Visa, I own stuff like that. Like there's no guarantee that 10 or 21 years from now that the yield on cost for those positions for me might not be like, that might be high enough to do what I needed to do. It might be 7-8% and we're good. And I don't need to sell. But in the case that I do, I'm also going to have, 21, in that case, it'd be 22, 23 years worth of owning that stock, building that position, having all that capital appreciation, market outperformance, 10% dividend growth rate year over year over year over year. Like as a whole, with all 11 positions in my portfolio, I have an 11% dividend growth rate total, like between all 11 of my positions. So it's like one of those things where like, if I put $0 into my portfolio this year and just reinvest the dividends, I'm going to make at least 11% more than I made last year.
Right. No, and that's tremendous. And 30 years from now,
it'll be doing something. It'll be pretty cool. So,
yes.
Okay. So the transition, okay. So last thing I wanted to ask you about that yield max, cause like with your experience, you might be a good person to ask this to. So there's a strategy out there and I want to do a video on it, but I just can't wrap my head around like the best way to cover it. But like, there's a strategy out. We all know about the dividend snowball, right? Like that's where you buy a stock, it keeps growing and then gets bigger and bigger and bigger, pays you more. You put more into it. It pays you more next time. So. So there's a method. I don't know that it's new, but I don't know that it's not, where people are calling it like the dividend avalanche method, which is where they are putting, let's just say $1,000 into TSLY, which is a yield max Tesla covered call. Right. They're putting that in there. That'll pay a dividend of whatever it pays. I don't know what TSLY's yield is anymore, but like it'll pay whatever it pays. They'll then take that money and put that into something quality, such as like, SCHD, VOO, or whether it's an individual quality company, Apple, Visa, Microsoft, whatever. So like I see so many people, whether it's comments on the different groups that we're in or whatever, where that is their method. They're like, oh, I know this is skeptical, but they're so obsessed with getting that income every month, whether it's, quote unquote, good or bad income, which I don't know that that's a thing, but like they're so obsessed with getting that and then taking that money to put into something else. And my question for them is always like, why wouldn't you take the original $1,000 and put it in that company in the first place? Like, does that make sense to you? Like, what, am I missing something?
Right. No, you make sense. What those people are ignoring is the total return. Mm-hmm. They might get 30 or 40% dividend on the TSLY, but their original investment is going down 50 or 60%.
Yeah. Yeah, and so the original $1,000 that they had is now worth $900, and they got $65 to replace it with and put it into SCHD.
Right. No, for those type of investors, I agree. You're much better off buying SCHD or there's a whole slew of them: VIG, SDY, NOBL. You'd be much better off investing in those right from the beginning and ignoring the TSLYs.
Yeah, I was just curious your thoughts on that, because I see so like I thought about it too. Like I when I first started dividend investing, I think everybody goes through this where they go through the thing and they're like, okay, so if I own it before the ex-dividend day, I get paid on that, the dividend capture strategy. Everybody thinks of that and they don't know what it's called. They're just like, oh, this is a good idea. I'm going to own it. I'm going to be declared for the dividend. Then I'm going to sell it. And then I'm going to take that money and put it in something else that's about to declare. And like, you think that's going to work, but it doesn't. I mean, I guess in very few situations, you might find a way to make some extra change, but in most cases that doesn't work.
Right.
And then, like I said, then you have like the dividend avalanche method, which was something I thought about a while ago. And then I was like trying to figure out like, what do they call this? Like there has to be somebody, I can't be the first person to think of this. So, but I see a lot of people, whether it's comments or actually original posts where they're just like, oh yeah, I own TSOY and NVDY and Coney and all these other yield max ones. They take all this money and then they put it. They're like, oh, they try to like justify it. They're like, oh, then I put it in quality companies after that. I'm like, why wouldn't you just put the original investment in quality companies? You'd be better
Right.
off. I don't get it. Okay, so in your time, you have to have something that you regret selling, and then something that you bought that like maybe you identified, you know, hey, this is going to be a good thing for me to own like a long time ago. So what would be your selling regrets and your buying brags?
Selling regret would probably be, if you recall, when COVID hit in March of 2020, the stock market took quite a hit.
Mm-hmm.
And at that time, I decided to lighten up a little bit on equities and um, move money over to fixed incomes, thinking those would be a little safer. And then what happened after that is the inflation hit and Federal Reserve started raising interest rates. So the fixed income investments started declining because as interest rates go up, bond prices come down, the inverse relationship there. So I probably regret lightening up prematurely on equities.
You got to experience the COVID crash twice.
Right.
That's
Yeah.
not good. Yeah, that's no good.
Yeah. So that would be a regret. And I'm sorry, what was the other
Just like a
part?
buying brag, like maybe a company that you identified at, you know, $10 and now you're, you know, a bazillionaire with it.
Oh,
Did you own Nvidia back in 2016 by chance?
yeah. No. I guess being a long-term holder of, like I mentioned, Apple and Google,
Mm-hmm.
those would, and holding on to those over all the years, I guess that would be my brag. Berkshire Hathaway, have a tiny position in that, and that's done well
Do you
over a
have
long
like a
time.
ridiculous cost basis in Apple and Google?
Right. Yeah. It's, I haven't looked recently, but it's, Apple is around 190 now. And yeah, my cost basis is under, it's probably around 50 or so.
That's ridiculous. Yeah. I can't
Yeah.
wait for that for me. Like I haven't held like anything that long yet. So it'll
Right.
be cool, really cool. So one of the things I was thinking about, so nobody take this for you people watching the video, but like one of the things I was thinking about like is doing a video on like the emotions of the stock market and like how I combat a lot of those. And what so I buy daily, just because like I like to do a lot of research, but like it's not like super in depth research because I just don't understand that stuff. So like the research I like doing is like, okay, like what would be the best day to buy, like best day of the week, best week of the month, stuff like that. And I was like, okay, this is too much work. I was like, I'm just gonna divide how much I want to put in my stocks by however many trading days and put that much in every day. Whether it's an up day, down day, I don't care. I'm just gonna get the average of the whole month. I'm gonna buy every day. So that's how I was able to eliminate the emotions of like, oh, I want to buy on Tuesday, but it's a really green day on Tuesday. I don't want to buy on Tuesday, but then like maybe tomorrow it'll go down, and then it doesn't go down. It goes up another 2%. Like I'm just like, oh, like I never bought. So I didn't want to do that. But one of the things I wanted to do that was just like I would think would be fun is like finding my cost basis, which I already know my cost basis for all my stuff, and like plotting the inception age of when I would have bought that fund. So if I were to buy Costco, like today, I think right now my cost basis on Costco is like 522 or something like that. I bought it originally at like 494, and because I buy every day, like it slowly has gone up, which is fine. So I
Right.
wanted to go back and be like, okay, say it's 522 even, like my cost basis today. I wanted to go back and try to find on the stock chart when is the last time Costco was at 522 and find the difference between that day and today and say my current age for my Costco position in like cost basis years or whatever you wanted to call that would be as if I started my whole position on this day. And just like watch that move throughout time. I think that would be a cool thing to track just because I like tracking stuff on spreadsheets anyway, but it would just be fun. And like for you, say your cost basis in Apple is $55, for you to be able to say, okay, if I were to start my whole Apple position on the last time that Apple was at $55, that would have been however many days or years ago. Like that would be pretty
Right.
cool to see. I don't know. It's just little stuff like that. I'm just like, okay, like what else can I track that's like just something cool to see over time and stuff like that. I don't know. I think that would be fun.
Right. No, that is fun. I mentioned the yield max funds, and that I just dabble in those for fun. And what I do with like TSLY, with every dollar drop, I'll add a few shares. With every dollar rally, I'll lighten up a few shares. So as the price of TSLY goes up and down, I'm constantly buying lower and selling higher, and it lowers my cost basis with um, every round trip. A buy followed by a sell, or sell followed by a buy, and I I like tracking my cost basis for that, just for fun, to see if I can, how low I can get it.
So I'm assuming you haven't done too many sells on TSOY.
Right.
Because it seems like it's
Yeah,
only going down.
Yeah. It actually bounces around a little bit.
Yeah.
So not too long ago, I lightened up at, I think, $12 a share. But
Yeah.
more recently, I added at $10 a share, and now it's trading in the nines. So
Yeah. Hey, get ready to add soon. You're going to be buying some more here soon.
Right. So yeah. So TSLY is still underwater a little bit for me, but AMZY and NVDY, those are in the green, using the same, similar type strategy of adding on dips, lightening up on rallies.
Yeah, when my best video on my channel to year to date or so far is the yield max comparison video, where I was just like wondering, like, that was when I first heard about them. I was like, what are these yield max things everybody's talking about? And I remember putting that video out, and everybody was like, that by far has like my most interaction, my most likes, most dislikes, all the stuff, and they were just like, you don't understand. It's the yield max funds are gonna be great later on, like right now in a bull market. And I was just like, were we like in a bull market? I feel like we just got out of a, like 2022, everything went down 19%. I was like, what bull market are you talking about? But so it was just all that kind of stuff. And it was funny because now I look back at that video, and like the whole point of that video was just like, okay, whether the fund that it tracks does or doesn't pay a dividend, it didn't matter. Every fund that it tracked, you were better off owning whatever the thing it was covering than owning the yield max version.
Right.
Like in terms of like actual like 10-year return, or in that case it was like, a year return, because they haven't been around that long. But like it was like, okay, from November 22nd to whatever day I did that video, would it be better to own Apple or APLY? It was better to own Apple. It was better to own Coinbase. It was better to own Tesla. It was better to own Nvidia. It was better to own everything else but the yield. And again, like I said, I got a lot of praise on that video, a lot of hate on that video, where they were just like, oh, you don't understand, it hasn't been enough time or whatever. And I'm like, I don't know that this gets better with time.
Right. I remember that video. In fact, I was one of the people to comment on it, and praising your analysis. What I would suggest for that is maybe redo it every year, as the yield max funds have more history.
Yeah.
And they traverse, up markets, down markets, sideways markets. Because I think you'll find on yield max will outperform the underlying stocks on sideways markets, probably the most.
Well, how often do we have like is it realistic to expect a market to go sideways for an extended period of time? I know it has happened before, but like in history, it's this like, okay, bear markets last this long, bull markets last like 3 times longer. Like how long is the sideways market?
Right. Yeah. Good point. Yeah. Not often do they trend sideways for months on end.
Yeah. So I feel like that's just like a strategy where they're like, hey, in this case that happens 0.5% of the time, these things are going to kill. And I'm like, yeah, great. Like if you own it during that 0.5% of the time, I applaud you. Good job. But like in all the other scenarios, I'm like, I feel like there's better options.
Yeah.
Yeah. So I don't know. I don't hate on the yield max funds. I just think it's fun because like it's one of those things that I remember when they were like coming out, not necessarily coming out, but when they got like really popular, that's when I put that video out. And that was, like I said, my best video. And it was just one of those things where I'm just like, so many people thought I was just like poo-pooing on it. I was like, no, like I was genuinely curious about these yield max funds. I heard about them and I did the research I would do for myself to determine if I want to own it or not. Like one of the new positions I put in my Roth. So I used to own QQQJ and QQQM. So M is like the current NASDAQ and then the J is like supposed to be the next gen NASDAQ, like I guess the more small cap companies. The QQQJ wasn't doing well for me. I had it for like, I don't know, 2 years. It wasn't doing well. It was lagging everything else. And I still have the NASDAQ exposure with QQQM. So that was a 10% position. So I cut that. And one of the positions I wanted to add just for fun, like I said, it's in my Roth, whether it doesn't do good or does do good, it's indifferent. But one of the positions I added was f.i.r.e. It's like my newest holding. And that is I think it's a triple leveraged S&P 500 fund. And I'm hearing people on like some of the comments, they're talking about, oh, that's not really a buy and hold. That's a this or that or whatever. I look it up on Dividend channel and I check I think it has like 25.85 years worth of history or whatever. Like that's the farthest back Dividend channel goes.
Right.
It is destroying the S&P 500. And that's a buy and hold. That's a $10,000 investment all the way back then. Drip the dividends. That's it. Like I'm not selling during down markets. Right. I'm not doing any of that. And it's like when you look at it's not close. It's not even close. And I'm just like, okay, what? Like in theory, is this not a buy and hold, or are people just saying that because like as soon as you mention like triple leveraged or whatever? Now to be fair, I don't own anything else like that, but it was just one of those things, and I was like, why not? Like my biggest position in my Roth is 40% VOO. And then I have 6 other holdings. That's including one of those. And those are all 10%. That makes up the 100%. So it's just one of those things. And I'm just like, man, like, I don't know. Maybe people don't understand it. Maybe they're like, oh, they're smarter than whatever. And I'm like, okay, well, you can say all these things, but the numbers prove this could be a buy and hold. Why not? So I don't know. What are your thoughts on that?
Right. Personally, I don't own f.i.r.e, but if you buy and hold over the long term, right, the S&P and the Dow Jones and everything is probably, it's safe to say that 20 years from now it's going to be S&P is going to be higher than it is today.
Yeah, and it just hit an all-time high like yesterday.
Right.
So and that's my thing is just like bear markets and bull markets, like clearly for something to hit an all-time high, it has to go up more than it goes down. Like that's how numbers work. So like I don't care. Like if we have another COVID crash or whatever, we go down 40%, it goes up. And they're like, because everybody, like you always see these charts where they're like, if you lose 10%, you need to make 11% to get your money back. Like, yeah, that's cool. Yeah. Clearly we've done that decade after decade. Like that happens all the time because we hit new highs. Like that literally happens.
Right. So no, I agree. f.i.r.e, that might be a very good investment in a long-term portfolio.
Yeah. If you haven't looked into that one, like just for funsies, like you can just look into it and see. Let me know what you think in a comment or whatever. I just look it up on Dividend channel, and I compare it directly to the S&P 500, and I was actually surprised to see that it had as long of a history as it did. I was expecting like some short-term thing, but it was like when I click on. I just keep the filters for whatever like the longest distance is, and I hit search or whatever button it is, and it goes back as far as it goes, and I think it was like 25.85 years or something like that, comparing directly to the S&P. Both of them starting at the same time, ending at the same time,
right?
And it was 3-4 times better than the S&P 500, and I was like, okay, like what? Like that's a long term hold to me. I don't know what considers long term, but I think 25 years counts. So
right, yes.
Okay, so next question for you. So over the course of your investing career, you've definitely had certain milestones and achievements that you've hit, obviously. So like what are maybe some of the most recent milestones and achievements you've hit? What are maybe some milestones and achievements you are getting close to hitting? And then I want to know, like, what role do those milestones and achievements play in keeping you motivated in investing in dividend investing specifically because it's such a long game?
I guess the milestone I'm most proud of is now that I'm retired, I don't need 100% of my dividends to live on. I can continue, if I take half my dividends and use that for living expenses, the other half of my dividends I can reinvest in the market. So I guess that's a goal that I'm proud of, that I can continue, growing the portfolio, whatnot. I don't live an extravagant lifestyle, but I don't scrimp and save either. So I guess, yeah, that's something that's good. And I'm sorry, the rest of the question was
Like
what future?
basically just like what role, like having small steps and achievements that you can achieve along the way, like what role does that play in like keeping you motivated?
Um, I like. Well, let's see.
Maybe it's even more of a past tense question. Like what role did it play? Like as you were achieving, like, oh, here's my first $1,000 a month in dividends, my first $1,500 a month in dividends, like seeing those milestones, like as
Okay,
you're coming up, you're just like, man, like this is really showing me it's working. I can do this, like all that kind of stuff.
right. I see what you mean. Okay. Every month, at the end of every month, I'll total up my dividend income, and if it's higher than the same month a year prior, then that's something that I try to strive for,
Mm-hmm.
to grow my dividends year over year. Um, and then I think I mentioned with a lot of these funds, I'll add on dips, lighten up on rallies. So I look at that number, kind of like trading profits, as over and above the dividend income. And I I like seeing, positive numbers there, that all these little trades that I do um, are profitable over the long term. Um Achievements. Um, yeah, I guess that's pretty much what I do on a monthly basis, is try to quantify that things are still growing upward.
Okay, so I mean, I think okay, this is going to be a perfect segue. So as long as I don't mess it up. So
Okay.
first part of the question is, when now that you're retired and living off of your dividends, did you have to do any like portfolio reconstruction to basically like even out your months? So in other words, like you don't want to get like 10 grand in January and then get, $500 in February. Did you have to do anything for that, or do you just budget accordingly, like, which I think most people probably do? They're like, hey, over the course of the next quarter, I'm going to get this much. I need this much per month. Let me make sure I'm taking that out. Or how do you do that?
Right. I guess in the last few years, I've added closed-end funds to my portfolio. I didn't have any 4 years ago, and now I do. And a lot of those pay out monthly,
Mm-hmm.
and they pay in the 8 to 10% range. So that helps out tremendously, having monthly payers. And
Mm-hmm.
a handful of my ETFs also pay out monthly. And then another part of my portfolio, on some of these dividend stocks that I own, let's say Apple, Procter and Gamble, uh, 3M, TJ Maxx, I sell monthly covered calls on those,
Mm-hmm.
and that generates some extra income on a monthly basis. And so I don't have too much up and down throughout the year. Each month is pretty steady as far as income generation and dividends.
Okay. So, and so last week's interview, I spoke with Steve, Steve Sellingut, and I
Yes,
consider him to, he's like the closed end fund god. So, like,
right.
do you think, like you said that you've gotten into closed end funds the last like 4 years? So, do you think those are good for somebody that's, has a long time horizon, let's say 20, 30 years? Do you think those are good for that, or do you think that those are better used for when you do need the income in your portfolio?
Okay. I think they're good for all ages.
Okay.
In fact, I'll do a quick plug. I've known Steve for 4 years, and here's his latest book,
I got a
Fred
copy coming
Wilson.
on the way. I'm ready for it.
Okay, it's a great book. Highly recommend it. And to your viewers that missed last week's video, go back and watch that with Steve. Um, what I like about the closed-end funds that Steve speaks of, the income is, say around 10% a month or, a year, but paid monthly. And for the way I invest or the way I trade, these closed-end funds, their share prices bounce up and down. So it's real conducive for adding on dips and lightening up on rallies, which I do quite a bit with the closed-end funds. So they might be paying 10% in dividends a year, and then I'll earn another 2 or 3% on these buying on dips, selling on rallies. So my total return on closed-end funds be 12 to 15%. I think the income's great for someone retired, but for younger people, if they take the distributions that come every month and just keep reinvesting them, either through a drip or adding new funds with the money, I think they'll see tremendous growth over 20 or 30 years.
Okay. Yeah, I was wondering that. I think I asked Steve that same question, if it was just like pros and cons of closed end funds, and like whether they're not necessarily exclusive, but whether they should be considered exclusive for like people later in their investing journey, or if they can be used like if I was 18 years old starting a portfolio today, would a closed end fund still make sense?
Right.
Yeah. So it was kind of that thing. Okay. So here's my segue that I didn't ruin. So with you having the closed end funds, with you living off your dividends, or at least part of your dividends, how were you able to determine when enough was enough? Like, when did you, was there a certain percentage of your income that you needed your dividend portfolio to generate, or like, how were you able to determine that?
Well, I guess my goal with my portfolio is obviously to have enough income to live on, but secondary goal is eventually I want to pass it on to my children and grandchildren. So that keeps me motivated to keep growing the portfolio for the long term. I'd like to leave something for them too. So I guess, those are the two primary goals of my investing: is what I need to live on, and then to pass it on eventually.
Yeah, and like that is like a kind of a tricky balance for you too, because you're like, hey, I need to make sure I'm having holdings in this portfolio that are going to get me what I need currently, but
Right.
also I need to balance my and this is where your diversification comes in, because you have to balance that with like, hey, I want things that aren't gonna lose 60% of their value because they're all focused on income, because I want to pass it on. So that's
Right.
that's a whole tricky thing right there.
That's why I keep the TSLYs and yield max, very tiny.
Yeah, that makes sense. Okay, so now I'm curious. So, do you have any specific like criteria or metrics that your stocks need to meet when you're selecting them? And like maybe like how do those criteria and metrics differ between like it's almost like you have two portfolios in one, with what you were just talking about, with like the portfolio part that you're going to pass on and the portfolio part that you need to live on. So like what do you have different metrics for each of those, and like what are your just overarching metrics that your portfolio needs to meet?
I like to look at the total return. For me, it makes no difference if I'm getting 2% in dividends and 8% in growth, or if I'm getting 9% in dividends and 1% in growth. I'm still getting a 10% total return. And right now, probably the vast majority of my portfolio are ETFs and those lesser degree closed-end funds. I look for diversification across all different assets. Right now, I'm probably a little heavier in income than equities, but I'll do an income, I'll do emerging markets, high yield, and then ultra treasury bills and so forth. Just across, I try to cover all my bases there. But the metrics, I guess, would be different for equities. I would look for, total return there over the long run, and the income funds. Just, there's really no metric that I look at there, because the bond market, I'm trying to get the words here. I just try to cover everything on fixed income, short term, long term, high yield, low yield. And I figure whatever comes, I don't try to predict the market or interest rates. I figure whatever's coming in the future, I'll have it covered.
Yeah, I feel like that's a losing battle. I feel like every week somebody's talking about, oh, the Fed's gonna do this or this is gonna happen or whatever, and I'm just like, that's exhausting to me. Like, there's always something gonna happen. Like, just plan for as many things as you can, and then whatever happens that you didn't plan for, for next time. Like, I don't know, I wouldn't worry about it. So,
I never tried to predict the moves, the future moves.
There's people that just have like access to more things that we have access to, whether it's like computers or information or whatever, or just like knowledge and wisdom. They have access to more stuff than we have access to, and they get it wrong. Like, what makes you think you with your Google research can get it right, but they get it? Like, I'm just like, I don't know. Like, it's just one of those things where like have some like pride to say, yeah, we don't know. Like, we're like, just plan for as many situations as possible and go from there. Like, or not even as many, like plan for the most likely situation. Like I said, for like what you were talking about for like the yield max stuff, like, yeah, it's cool. Like, maybe have a fund that shorts the market if you think the market's going to go down. Maybe have a fund that you think is going to grow with the market if you think the market's going to grow up. But like planning for it's almost a waste of your time to plan for the sideways market, because that doesn't happen often. Like, it's just that like you might have a little period of time where it does go sideways. And I think there was like actual periods from like 2008 all the way up to like, what was it, 2013 or something, where the market basically traded sideways. But like, in the grand scheme of things, that little 5-year window is like nothing compared to like every other time was a bull market or a bear market. Like, that's just how it works. So,
True.
Okay, so I think we have 2 questions left. So we're actually doing really good here. So this one is one that it's always tricky for me to ask it, but like hopefully it comes out right. So like, in the dividend space, there's a lot of like myths and misconceptions, just like things that you hear that just aren't true, or like rumors that are started about like this is most important, when in reality it's typically like the opposite. So like, what would you say are some like myths and misconceptions that you hear in like investing or dividend investing specifically, like that you just like want to debunk, that you just like, hey, this really bothers me that people say this all the time, but it's just not true? Like so the example I always give is like when people say that like dividend investing's for old folks. Like, you need to wait until you're 60 to do dividend stocks. I'm like, actually, it's way better to do it when you're younger, not when you're older.
Yes, no, that's true. That is a good myth. I guess I'm trying to think. I would guess, these dividend traps that people talk about, that's probably more true than myth. Even though there's a couple that I own that, like AT&T, I will continue to hold that, maybe out of stubbornness or, whatnot.
Hey, good news with AT&T is either you're right and you get to prove everybody wrong, or you're wrong with everybody else, so nobody's gonna pick on you because everybody else is also wrong. So
True.
Yeah, I guess that's the glass half full approach with AT&T.
Yeah. With AT&T, I have strict trading rules that on dips I'll add shares, on rallies I'll sell covered calls on it, and so all along I've been treading water on the stock share price, but I've continued to collect the dividends. So
Oh, at least so you're at least even with it.
yes,
I know
so
people that are like refuse to sell it, and they're like, "Yeah, it's my biggest dog. I'm down 60%." I'm like, "Why are you holding this? Like, what are
right,
you? What are you?"
yeah. So I've negated some of that 60% drop in share price by actively trading around my position.
So did like I do want to ask you that, like, does holding individual company, because I know ETFs are really tricky, right? Like, especially the ones that don't pay monthly, like they vary so much in what they pay from quarter to quarter. But
Right.
like with individual stocks, like does that impact you? I think I know the answer to this, but like how much does that impact you when you're like, okay, I'm forecasting that I'm going to get this much in income from AT&T, and then they do a 50% cut? Like, what does that do to like your how you live right now, because you're living off the dividends?
Right. Yeah. When they do a dividend cut, yeah, it's painful. Um, but by being diversified, if AT&T suddenly cuts their dividend again, it's not going to impact me too much, because it's every holding in my portfolio is, you know, like 1 or 2%,
Mm-hmm.
and it won't won't derail my retirement.
Yeah. So in reality, if AT&T is 1% of your holding, your portfolio, and they're paying you, $1,000 a year, you're really going down to $500 a year. But like now you're getting 0.5%. Like now it's 0.5% instead of a whole percent. So I mean, it's not that
Right.
big of a deal. Yeah.
Yeah. Yeah. Um, but as far as the myths of investing, I rarely, if ever, watch CNBC or those shows or listen to the talking heads on those.
You don't like Kramer?
Yeah, no, not a fan. uh, so I'll ignore them. And then, like Seeking Alpha, well, AT&T is a great example. Seeking Alpha comes out with a new article on AT&T almost daily. One day it's bearish, next day it's bullish. So uh, I pretty much tune out all that noise from the so-called experts.
Yeah.
And
Yeah.
I,
Nobody's ever brought that up before. I think that's a really good point that you're bringing up, is like the like advice, like, because that's kind of so the next question is like, if somebody decided that they're going to start investing, on Monday, so they're going to see this on Sunday, they're going to start investing on Monday, they want to invest and they want to do dividend investing, like what would be tips and tricks for you, advice you would give them? And I think that's a really, really good one that you just mentioned, is like, be careful about the experts, because nobody knows.
right, exactly.
And like the thing that really bothers me is like people base a lot of stuff, like they try to project what the share price is going to do 10 years from now. That's based off of already somebody's projection. And literally every quarter, what happens? We get quarterly reports, and they say whether they beat or missed earnings and revenue and stuff like that. That's literally saying, hey, were these experts right or wrong? Because that's what they just pulled those numbers out of wherever they're pulling them. And
Right.
like the idea is whether they were right or wrong. That's literally what they're judged on quarterly. But yet, like, there's no penalty for being. It's not like if you get like a bunch of predictions wrong, you're off the panel. Like, you just keep making predictions.
Right. No, they talk out of both sides of their mouths.
Yeah.
So they'll say, just as I predicted, even though
Yeah.
they said something different.
Yeah. Well, what's the saying that they say? They say bears are never wrong; they're just early.
Yeah.
Yeah,
Right.
that's like the saying I hear all the time, and they're just like, "Oh yeah, like what was 2023 was supposed to be a recession, right? We went up 19% or 24%."
Yeah.
Yeah. So like imagine listening to that, and then you just missed out on almost 25% gain just because it was supposed to be a recession. Then they're going to say, "Oh, 2024 is supposed to be a recession." Maybe it is, maybe it isn't. But if it is, they're going to be like, "Oh yeah, see, we told you it was 2024." But like, "Yeah, but you also said 2021, 2022, 2023." Like eventually you're going to be right. Like, I don't need to be a meteorologist to say it's going to rain today, and if it doesn't rain today, it's going to rain tomorrow. Like eventually I'll be right.
Yes.
Unless I'm in like the desert or something, maybe I won't be right. But like, I don't know, odds are in your favor that if you keep saying something, eventually it's right. Broken clock's right twice a day, right? So,
Right.
Yeah, that I think that's a really, really good thing that you just mentioned there about like the experts. Cause like I remember, I don't know, probably a year and a half ago on my channel, I did a video. I don't even necessarily remember what the premise of the video was about, but it was talking about like what stocks the experts think are going to do, like whether they're going to go up or down. Like I said, I don't remember that much, but like it was one of those things. And I quickly realized I'm like, not that these guys don't know any more than us, but like everybody's guessing. Like, yeah, it might be an educated guess, but like how I've asked this question like in fun before, not even about investing, but like how bad does a guess have to be before it becomes an uneducated guess?
Yes.
Like that's almost what this situation is. It's like if I say, "Hey, what's the weather today?" If I say purple, that's an educated guess. Like that's not even close. But like if you ask me the weather today, I'm like, I don't know, 35 and sunny. I'm like, okay, well if it's like 34 and rainy. I'm like, was I that far? Like I was close in the temperature and like rainy and sunny. Like maybe it wasn't rainy over here, but it was over here. Like, I don't know. Like to me, that's an educated guess still. Like I said, okay, it's winter time. It's going to be cold. Like, I don't know. It could be rainy or sunny. I don't know. But like, so like how, like, I don't know. That's not even like a rhetorical question, but like how far off does a guess have to be an uneducated guess? Like, I don't know.
Right.
So I don't know. It's just something I thought. But so do you have anything else like other than like, talking heads don't know as much as they put on that they know, anything like that for like the new investors, like really watch out for like the one I always get is like, watch out for yield traps, understand your timeline, stuff like that. So what else do you got for us?
Right. I would say go slowly. Don't go all in on, one or two investments. Diversify and, try to do your own research. As far as that might be tricky for the newer investors because they don't have the experience researching investments. I guess for them, learn as much as you can. There's a lot of good books out there on dividend investing and so forth. So educate yourself would be what I would tell the new investors.
Mm-hmm. Yeah, and my tip that I always like to try to give is just like investing something that like in order to be just wealthy in general, you almost have to do it unless you get lucky. But like you're not going to get wealthy by saving. Like the odds of you getting wealthy by saving is not great.
Right.
So like investing is the way. If you don't want to, like my advice, and again, not financial advice, whatever, but like my advice is always like start with an index fund, whether it's the broad VTI, whether it's VOO, whatever it is. And if you never gain an interest in investing, always put money into that, whatever that fund is. Like just keep doing it. Like whether it's $50 a paycheck for the rest of your life into VOO, you'll be okay. Like you're going to get there. But if by adding VOO and you start to get a dividend and you're like, okay, well, what makes up VOO? Why is it doing well? Like all kind, like, are there other things that are like VOO, like the NASDAQ, the Dow Jones, like stuff like that? Like you can start slowly learning about the stock market and investing in general, all while you're still growing your original money that you're still putting into VOO. Like that's always like my super basic information that I always like to tell people is just like, okay, like don't worry about what you do and don't know right now. Do this basic index fund, get your feet wet, learn as you wish. If you keep learning, you can branch off from VOO. And if you don't want to keep learning, just keep going VOO or VTI or whatever it is.
Right. No, ETFs are an excellent vehicle for the new investor. It gives them instant diversification. The fund managers, whether it's index fund or maybe a dividend fund like SCHD, they do the investing for you, and they know what they're doing. They're professionals. So, no, I would agree. If I had a brand new investor, I would recommend the ETFs.
Yeah, and then like I said, you can branch out if you want to, but if you're never. And what you were talking about by being diversified and stuff throughout the whole thing, like VOO is like 505 holdings or something like that. Like you're already diversified. It's already managed for you. There's a very low expense ratio. Like it's tracking the S&P 500, which is the thing everybody's trying to beat. Like you are the thing that everything's trying to beat. And fun fact, most people don't. So you're already better than most investors just by not doing anything. So, and there's all kinds of studies out there. It says like some of the best investor returns are like people that are dead because like they're not touching their portfolio and messing with it.
Right.
So it's probably better if most people just don't know a lot and they just put it in there and leave it alone.
True.
So, but anyway, Scott, it's been a super pleasure. Thanks again for agreeing to meet with me today. And also thanks again for all the support on the channel. I always see you liking all my stuff and showing love on the channel. So I appreciate that. Is there any closing remarks you got for the people or anything you want to say?
No, just have fun and, invest what you can. A dollar invested today, 20 years from now might be worth $5 or $6. So maybe skip that Starbucks today and
Yeah.
invest that for $5.
Yeah, I agree. Well, Scott, again, it's been a pleasure. I appreciate you very much, and we'll talk to you later.
Okay, thanks, Troy.
And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.